Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Applied Optoelectronics.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. StockAnalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So imagine you're building like the world's most advanced AI brain.
Okay.
You buy tens of thousands of the fastest processors on the planet, you wire up the power grid, and you get ready to turn it all on, only to realize you forgot to build a spinal cord.
Right, so the brain can't actually communicate with the rest of the body.
Exactly. It's this massive bottleneck that the biggest tech companies in the world are slamming into right now. And today, we're looking at the company racing to fix it.
Which is Applied Optoelectronics. And that's such a perfect way to picture this problem because right now, the entire market is obsessing over the brains, the GPUs.
Yeah, the graphics processing units.
Exactly. But Applied Optoelectronics is out there building the actual central nervous system. This company is going through an explosive transformation, evolving right before our eyes from this relatively small niche component maker into an absolute core pillar of global AI infrastructure.
And the market is definitely waking up to that transformation. But as an analyst, when I see the numbers attached to this company, my caution lights start flashing.
Because of the massive run-up.
Right. To put this in perspective, this stock is up over 358% in the past 12 months alone. And if you zoom out to their recent tracking data from the absolute bottom, it has surged like an incredible 848%.
It's an incredible run.
It is. But a spike like that is thrilling, sure, but we have to ask if it's actually sustainable or if it's just, hype.
All right, let's move into the wealth building context.
Yeah, so from a purely strategic standpoint, adding an asset like this to your portfolio requires you to know exactly what you're holding. In financial terms, this is a high beta stock.
Meaning it bounces around wildly.
Highly volatile, exactly. This is absolutely not a safe, steady dividend play that you buy, tuck away in a retirement account, and just forget about for 10 years.
Right.
It's a high-octane addition uniquely suited for the aggressive growth sleeve of a portfolio. And it carries a risk profile that matches those massive gains.
Which is exactly why the potential upside is so compelling. I mean, the wealth-building thesis here is entirely based on supplying the high-speed plumbing for the AI gold rush.
Wall Street is calling it the optical AI tax, right?
Yes. Think about it this way. Every single tech giant, whether they're building out a massive new language model or expanding a colossal data center, they have to pay this tax. They can't bypass it.
Because the AI brain is completely useless if the data signals can't travel fast enough.
Exactly. And the technology upgrade cycle happening right now is just unprecedented. The data centers are currently tearing out their old infrastructure and migrating from 800 gigabit speeds to 1.6 terabit speeds.
And they're already mapping out an eventual horizon of 3.2 terabit speeds between 2026 and 2028.
Yeah, it's moving incredibly fast.
But, for someone who isn't an electrical engineer, what does jumping to 1.6 terabits actually mean for these tech giants?
It's kind of like trying to push the entire volume of a rushing river through a standard garden hose and then suddenly upgrading to a massive municipal water main.
Okay, that's a huge difference.
Right. The sheer volume of data required to train modern AI is mind-boggling. When you upgrade to 1.6 terabits, you are doubling the amount of information that can travel down the optical fiber in the exact same fraction of a second.
So it's a classic S-curve.
Exactly, a multi-year S-curve adoption model. At first, only the top-tier pioneers adopt the new speed. Then the curve slopes sharply upward as the entire industry is forced to upgrade just to stay competitive.
Which creates a multi-year wave of massive demand. I love the S-curve framework, but here's the practical reality of riding that wave. Building a nervous system of that magnitude and manufacturing the physical glass and light components to make it happen, it requires a staggering amount of upfront cash.
Oh, definitely.
It's an incredibly expensive endeavor to retool your entire manufacturing base, which naturally forces us to open up their actual ledger and see how they're paying for this.
Now let's look at the fundamentals.
Right, because the fundamentals here present this really fascinating tension. On one hand, you have top-line euphoria, with money pouring in from customer orders. But on the bottom line, you have the heavy, gritty reality of what it costs to actually build these physical products.
Well, let's start with that top line euphoria because the numbers are staggering. For fiscal year 2025, they posted record revenue of $455.7 million.
Wow.
Yeah, that's an 82.8% jump year over year. The fourth quarter alone brought in over $134 million.
But the real story is the data center segment, isn't it?
Or absolutely. That segment's revenue surged from $44 million to roughly $75 million in a single quarter. That is the AI supercycle showing up directly on the income statement.
And management just raised their fiscal year 2026 guidance to a massive $1.1 billion.
They're projecting the entire business will more than double next year.
Which is wild. I mean, doubling a manufacturing business in a single year is incredibly difficult. You can't just flip a switch. You need a rock-solid operational foundation. Which brings us to what I think is their true competitive moat. In the semiconductor and networking space, supply chains are notoriously fragile. If you're waiting on a tiny part from an outsourced factory halfway across the world, and there's a shipping delay, your entire quarter is ruined.
But Applied Optoelectronics has a vertically integrated model.
Exactly. They produce their specific lasers, known as indium phosphide laser chips, 100% in-house.
They control their own destiny because they make the most critical components themselves. And that in-house capability fuels their major technological advantage, which is linear pluggable optics, or LPO.
Okay, pause right there, because linear pluggable optics sounds like something out of a science fiction manual. Explain LPO and why it actually matters to the bottom line of an AI data center.
Okay, let's break it down. In traditional optical cables, you have a component inside the plug called a digital signal processor, or DSP. Think of the DSP as this power-hungry mini-computer whose only job is to clean up the data signal as it travels down the wire. Because it works so hard, it generates a massive amount of heat and uses a ton of electricity.
Right, which is a huge issue in data centers.
Exactly. Applied Optoelectronics' new LPO technology essentially removes that mini-computer entirely. It creates a direct, clean freeway for the light to travel on.
So by removing that processor, what happens to the power consumption?
It cuts the power usage by 50%.
That's massive.
And it drastically reduces the data latency, meaning the signal arrives faster. In an AI training cluster where electricity and cooling constraints are literally the #1 bottleneck holding companies back from building bigger data centers, a cable that uses half the power is a game-changing competitive advantage.
It's brilliant engineering, without a doubt. But, you know, as the cautious one here, I have to stress test the balance sheet supporting this brilliant engineering.
Fair enough.
Yes, they turned a profit in the fourth quarter when you strip out one-time accounting costs, and their gross profit margins expanded nicely to over 31%. However, their free cash flow, the actual cash they have on hand after running the business, is under immense pressure.
Because of the new facility.
Right. They are currently building out a massive new manufacturing facility in Texas.
A state-of-the-art facility exactly where they need it.
True, but let's contextualize the size of this commitment. It's a 210,000 square foot facility. To picture that, imagine walking across nearly 4 full-sized football fields.
It's huge.
And the price tag for this project is $150 million. Now they're sitting on a cash position of $260 million. That means they're committing more than half of all the cash they have in the bank to a single building.
Yeah, it's a big bet.
And their existing debt is manageable, about $67 million, plus another $125 million in convertible notes due in 2030. But to make sure they didn't run out of money during this massive Texas expansion, they recently had to execute a $250 million at-the-market offering.
And they upsized that offering and completed it in just a couple of days.
True.
I mean, that shows incredible institutional hunger for these shares. The big Wall Street funds couldn't buy it fast enough.
That is true, but we need to explain what an at-the-market offering actually does to the everyday investor listening right now. It means the company created new shares out of thin air and sold them to the market to raise cash.
Right.
It's like having an 8-slice pizza, and suddenly the company cuts it into 12 slices. You still have your one slice, but it's physically smaller. It dilutes the value for existing shareholders.
Yeah, that's the downside.
And my major concern is this. If they are burning through cash and diluting shareholders to build 4 football fields worth of manufacturing space in Texas, isn't that a massive financial risk if demand suddenly softens? You're building a factory on the sheer assumption that the orders will be there to fill it.
That would be a terrifying risk, except they are actively securing customer prepayments to fund this exact expansion.
Wait, really? Prepayments?
Yes, they are not building it on a prayer. Their partners are literally fronting the cash right now to ensure they get priority access to the manufacturing lines when they open.
Wow.
When multi-billion-dollar tech giants are writing checks before the concrete is even poured on the factory floor, it proves an intense, undeniable partner commitment. And that massive, locked-in demand leads directly into what we can expect to happen next.
That brings us to the catalyst timeline.
And the next 3 to 6 months are stacked with pivotal events.
Ooh.
Let's talk about the biggest recent win, which completely validates what we were just discussing.
The massive hyperscaler order.
Yes. They secured over $253 million in combined 800 gigabit and 1.6 terabit orders from a single major hyperscaler, specifically targeted for March 2026 alone.
That's $250 million.
Exactly. Now, the company hasn't named names, but there is a widespread, very loud industry rumor circulating that this order is coming from either Microsoft or Oracle.
Which would be huge.
Right, when you land a check of that magnitude from a client at the absolute top of the food chain, it validates your entire technology stack to the rest of the world.
It certainly serves as a massive stamp of approval, but it also violently raises the stakes for their upcoming second quarter 2026 earnings, which we expect to drop in late July or early August.
Oh, absolutely.
That earnings call is going to be the ultimate test. The market has currently priced the stock as if that $1.1 billion annual revenue target is a guaranteed fact.
Right.
If management gets on that call and shows any signs of operational friction or delay in shipping these new cables, the market's reaction will be unforgiving. Investors will be watching the ramp-up of the 1.6 terabit products and their profit margin metrics with a microscope.
But we also need to factor in the massive macro tailwinds at their back that will help them hit those targets. Yeah. Later this year, we'll see the full operational deployment of their Phase 3 fully automated manufacturing lines in Houston.
Yeah, the automation piece is critical.
On top of that, you have the U.S. THAPS and Science Act, which is heavily favoring domestic manufacturing. The federal government and private hyperscalers are actively trying to move critical supply chains out of Asia.
Right.
And Applied Optoelectronics is perfectly positioned to capture highly lucrative sovereign AI cloud contracts because their cutting-edge lasers are actually made right here in the United States.
I hear you on the geopolitical tailwinds, but I have to push back on their platform dependency.
Okay, how so?
Well, think about the math. If a single massive client is driving a $250 million order, aren't they incredibly vulnerable to a single point of failure?
I mean,
If that one specific tech giant decides to pivot their data center architecture or simply delays their build-out by 6 months, the company's entire revenue projection for the year basically collapses.
that is a fair analytical point regarding concentration risk. However, the broader sector rotation into optical interconnects provides a massive safety net.
A safety net.
Yeah, we saw this exact dynamic play out with the explosive networking revenue coming from the major GPU manufacturers. The entire industry is upgrading simultaneously. If one client delays, there is a line of 3 others waiting to take their spot on the manufacturing line.
That's fair.
And you don't have to guess if the broader market believes this narrative. The market's reaction to all this fundamental news and these massive orders is best seen in how the stock trades every single day.
Now let's pivot to the chart.
Because the price structure here is fascinating. We're looking at a classic high momentum profile. This stock loves to run hot, but it has been interrupted by brief periods of intense institutional digestion.
Right, and to call this stock highly volatile is almost an understatement. The stock exhibits a 15% daily volatility profile.
It's just wild.
Let's put that in perspective for the listener. If a normal blue chip stock moves 2 or 3% in a single day, it makes the evening news. This stock routinely swings 15% before your lunch break.
Yeah, it's definitely not for the faint of heart.
And recently, we saw a technical shock that shook out a lot of everyday retail investors. The stock hit a 52-week high of $128.96, but then suffered a brutal, sudden 28.35% sell-off.
Triggered directly by the equity dilution scare from that $250 million offering we discussed earlier.
Exactly. Everyday investors saw the pizza getting sliced thinner, and they panicked.
But look at the bullish counter-narrative that emerged the very next trading session. The stock immediately rebounded by 12.4%, pushing right back up to $124.29.
Right.
That is a clear, undeniable signal. It shows strong institutional buy-the-dip psychology completely overriding the retail panic. While everyday investors were selling out of fear, the big Wall Street funds quietly stepped in, absorbed millions of new shares at a discount, and pushed the price right back up to its highs.
Which makes it an absolute dream for an active trader, but a genuine headache for a cautious investor trying to build a long-term position.
Yeah, that's true.
We've seen massive gap-ups on order announcements. For example, the stock surged 13% overnight simply because they showcased their technology at a recent industry conference.
Right.
If you're holding the stock and wake up on the right side of that gap, it feels fantastic. If you buy at the peak and get caught in a 28% dilution sell-off the next day, it is punishing.
But forming new higher highs establishes a sustained uptrend. And the fact that institutional money absorbed that massive offering so quickly ties directly into how Wall Street feels about the underlying health of the business.
So what does market sentiment look like?
If you look at the analyst notes and the financial headlines, the perception is overwhelmingly, almost euphorically bullish.
Euphorically?
Yeah, and for good reason.
Yeah.
Quantitative sentiment scoring ranks them as a top-tier market winner. You have major players like Rosenblatt Securities coming out with a street-high price target of $140 per share.
$140? Wow.
Their analysts are literally publishing notes calling Applied Optoelectronics the single purest play on the optical AI tax. And the smart money is actively accumulating.
Right.
For instance, Portland Capital recently increased its stake by 20%, bringing their holdings to over 500,000 shares. When the smart money buys heavy, the market notices.
And the speculative environment is also running incredibly hot right now.
Oh, the acquisition rumor?
Exactly. There are unconfirmed rumors circulating through back-channel analyst circles about a potential acquisition. Some speculate that a massive networking giant like Broadcom or Marvell might look at this company, see their vertically integrated laser manufacturing, and decide to just swoop in and buy them outright.
Which would instantly bolster their own AI networking portfolios. When you combine a $1.1 billion revenue guidance raise with institutional buying and massive acquisition rumors, you get incredibly strong bullish momentum.
True, but, you know, as an analyst, it's my job to weigh that overwhelming enthusiasm against the deep skeptics in the room.
Like Needham.
Exactly. Needham is maintaining a highly conservative hold or neutral rating. Their analysts are looking past the hype and pointing directly to historical execution risks and the extremely high valuation multiples the stock is currently commanding.
Yeah, they're definitely the cautious voice.
I think it's crucial for anyone listening to weigh Rosenblatt's $140 price target against Needham's caution. It sets the stage perfectly for us to examine exactly what could go wrong.
Now let's talk about the risks.
Yeah, the bear case here is substantial, and it centers on three very practical pillars: execution, scaling, and valuation.
Okay, let's hear them.
First, execution risk. Manufacturing tiny glass and laser components at a massive scale is a complex process. Just recently, they actually missed their 800 gigabit revenue expectations for a quarter simply because they had to pause the manufacturing line to optimize the software firmware.
Right, which slowed things down.
Second, margin compression. Bringing production back to the United States sounds great politically, but domestic labor costs are roughly 10 to 15% higher than in Asia. Consequently, we saw their non-GAAP operating expenses recently surge to consume 37% of their total revenue.
That is a big jump.
And finally, the valuation danger. The stock is currently trading at a negative price-to-earnings ratio, and if you look ahead, it's priced at over 30 times its projected earnings for the year 2027.
So investors are paying a massive premium today.
Exactly. They're paying for absolute perfection 3 years down the road.
Those are very real hurdles, but the company is actively mitigating them, and we need to look at how. Let's start with those U.S. production costs.
Okay.
The whole point of that Phase 3 Houston automation we discussed isn't just to build things faster, it's designed for ruthless efficiency. The new automated lines reduce human manufacturing labor hours by over 90%.
Wow, 90%.
Yeah, that massive drop in labor hours completely offsets the higher domestic hourly wages. Furthermore, in the current geopolitical climate, hyperscalers are more than willing to pay a slight premium for secure domestic supply chains that aren't at risk of international trade tariffs.
That makes sense. What about the dilution?
Well, regarding the dilution risk that caused the recent sell-off, management has explicitly signaled on their earnings calls that they're moving toward a more optimal mix of debt and equity financing. That strongly implies the heaviest, most painful dilution events are already in the rearview mirror.
I will certainly concede that the multi-year S-curve adoption in AI infrastructure is a very real, very powerful force. The technology is absolutely necessary. You cannot build the AI brain without the spinal cord.
Exactly.
But I have to insist that investors price in the reality of manufacturing at scale. Absolute perfection in their Houston and Texas facilities is required to justify a valuation built on $1 billion of forward revenue. Any hiccup in the supply chain, or any delay in rolling out the 1.6 terabit cables, will be punished severely by a market that expects flawlessness.
So with everything on the table, what's the final verdict?
Well, taking into account their vertical integration, the massive $250 million order pipeline, and weighing it against the very real execution risks of scaling up a U.S. manufacturing base, the analysis delivers an official bullish score of 8 out of 10.
The elevator pitch for the investor is clear. Applied Optoelectronics is successfully scaling from a niche, behind-the-scenes component maker into a core pillar of global AI infrastructure.
Yeah.
By leveraging their proprietary linear pluggable optics and their in-house laser manufacturing, they're capturing massive hyperscale orders precisely as the tech world desperately transitions to higher network speeds.
And as for the target horizon, the analysis defines this as a multi-year hold. If you're jumping in just to trade the daily 15% swings, you are playing a dangerous game. But holding through the 2026 to 2028 optical upgrade cycle allows an investor to look past the current heavy capital expenditure phase. The strategic goal is to capture the immense profit margin expansion and the significant free cash flow generation that should logically follow once these massive new Texas and Houston facilities are fully operational, paid for, and churning out product.
It really is a fascinating transition to watch unfold in real time. Just imagine years from now when we take these massive, instantaneous artificial intelligence networks completely for granted, we'll actually be relying on a physical infrastructure, a sprawling global nervous system of light and glass that was frantically being built out right now, factory by factory, order by order.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.